Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss whether or not your retirement assets are exposed to U.S. estate tax. Specifically, I'm going to discuss what is the U.S. estate tax, 2 questions you need to consider to determine if you are required to pay U.S. estate tax, upcoming changes in 2026 that could expose your worldwide estate to tax, strategies to consider to help mitigate or eliminate your exposure, and lastly, as always, a few action items for you to consider. Now, for most Canadians, the thought of paying U.S. estate tax will almost never enter our minds. After all, we live in a totally different country and file our taxes here in Canada. But what if I told you a portion of your assets may be subject to U.S. estate tax, or at the very least, you may need to file a U.S. estate tax return? Many of you might be thinking, well, that won't apply to me. I don't own a place down south. Well, you may not be out of the woods completely. I have come across a number of scenarios over the last few months with prospective clients who were potentially exposed to U.S. estate tax and estate filing requirements and were not fully aware of the implications. These are individuals and families that are tax residents of Canada and are not U.S. citizens or taxed as a U.S. person. So how were they potentially exposed to this U.S. estate tax? It all comes down to the legal jurisdiction or taxation a property or asset belongs to. In English, if the asset is domiciled in the U.S., it is a U.S. asset, the most common being U.S. real estate and shares in a U.S. corporation. So, for those of you who are snowbirds that winter down in Palm Springs or Florida, chances are you are aware of this potential U.S. estate tax on your U.S. real estate. However, what many Canadians don't know is that their U.S. stock portfolio may be subject to the same estate tax. Regardless of where you hold these U.S. investments, whether it be in a non-registered account or a registered account like a TFSA or RRSP, you may still be exposed. To add some clarity to this before I go any further, in your retirement portfolio, you most certainly will own U.S. companies. However, when these U.S. companies are purchased through a Canadian listed mutual fund or exchange traded fund, the IRS does not consider these U.S. assets, and therefore they are not exposed to U.S. estate tax. Again, this is because you own these assets indirectly through your investment into a Canadian listed fund. If, however, you own U.S. company stock directly in your investment accounts, you may be exposed to this U.S. estate tax. So, for those of you who own U.S. real estate or U.S. securities, pay close attention. If you answer yes to both of the following questions, your estate may be subject to the U.S. estate tax. Number 1. Do you own U.S. assets with a value exceeding $60,000 US? And number 2, will the value of your worldwide assets exceed the lifetime exclusion amount in the year of your death? As of writing this podcast episode, the lifetime exclusion limit is just under $13 million US. So while this high value will eliminate most Canadian estates, this amount is currently set to revert to $5 million US at the end of 2025. So I think what's best here is to go through an example. Say you live in Vancouver. You've seen your property value appreciate to $5 million. You have a vacation property worth $2 million and an investment portfolio worth $3 million, $1 million of which is domiciled in the US assets directly. In total, your estate is worth approximately $10 million in Canadian dollars. So roughly $7 million US dollars with today's conversion. Based on today's exemption of nearly 13 million US dollars, there would be little concern about needing to pay US estate tax. However, because the value of your US stock portfolio is over 60,000 US dollar threshold, your estate representative would still need to file a US estate tax return regardless of the value of your worldwide estate and regardless of whether or not there is an estate tax liability. However, if we look back in time to 2017, the last time the exemption was closer to $5 million, and apply the same worldwide estate value, we discovered that there is potentially an estate tax liability if or when the exemption drops at the end of 2025. So going back to our scenario with an individual living in Vancouver with approximate worldwide assets of $7 million US dollars, $1 million of which is held personally in US stock portfolio, their potential net US tax would be approximately 40,000 US dollars after certain credits are applied. If you want to see this calculator in action, there are links in the description to the calculator I used and more resources for you to dig a bit deeper into the subject. Now, as you can probably imagine, this is complicated. So please speak with a cross-border tax professional when you have more than 60,000 in US dollar assets. That said, there are some planning strategies you could consider to help mitigate the impact of US filing requirements or US estate tax. The first and most common would be to hold US assets through Canadian mutual funds or ETFs or corporations. So instead of directly holding US securities, consider holding them in the Canadian mutual fund or ETF or a Canadian holding company, which may insulate you from a tax liability but introduces many other costs and an increased tax rate on passive investment income. Now, these structures avoid triggering US estate tax, especially for portfolios holding US equities. The second planning strategy is to gift US assets or restructuring ownership during your lifetime. Now, you may be able to achieve this reduced exposure by gifting US assets during your lifetime. However, US gift tax rules may apply. You may also consider utilizing an inter vivos trust or family limited partnership for US real estate assets, or jointly owning property with a spouse, with planning around some contribution rules here. These options may also introduce deemed dispositions of assets, which could result in taxable gains being paid at the time of disposition and restructuring. The third strategy is to leverage the Canadian-US tax treaty exemptions. These tax treaties provide a prorated unified credit relative to the US asset values versus global real estate. Also includes a marital credit when assets pass to a spouse with proper structuring, and the ability to deduct certain US estate taxes or expenses against the estate. As I've mentioned earlier, please be sure to engage with a qualified tax professional to help with these parts. The fourth strategy is another option you can consider, utilizing life insurance to offset estate tax. This strategy could help to cover anticipated US estate taxes, avoiding forced liquidation of US assets, and provide overall liquidity to your heirs. This is a common strategy when US assets like large vacation homes or investment properties are involved. The fifth and last strategy is to complete annual monitoring reviews and valuations. If you have US assets, it's best to reassess estate exposure annually. This is especially relevant with the anticipated deduction to the worldwide estate exemption to decrease to $5 million in 2026. So if you tally up your net worth to be over $5 million US dollars and you have over 60,000 in US domiciled assets, it would be wise to plan for the 2026 reduction and forecast what the impact could be to your estate. Having this type of proactive approach to your estate plan will help to ensure your plans remain optimized as laws and assets values change. Okay, so that will do it for today. Only one action item for you today. If you own US real estate or US stock held directly worth more than $60,000, it's time to break out the calculator and start adding up your total worldwide estate value. Make a conversion for what that might look like if all these assets were priced in US dollars at today's exchange rate. If that number is greater than $5 million today, be sure to keep this on your radar, as the planned reduction to the worldwide estate tax exemption is set to decrease to around $5 million in 2026. I would strongly encourage you to reach out to your tax professional so at the very least you understand what a potential tax liability may be, and potentially start taking steps to help mitigate or eliminate that liability if possible. Okay, so that'll do it for today's episode. Be sure to add us on all of our socials, LinkedIn and Facebook. For all the links and resources discussed, check out the description. If you've been enjoying the show, please subscribe and leave us a 5-star review in your favorite podcast app. Be sure that you've signed up for our weekly Retiring Canada newsletter and share it with a friend or family member that you think can benefit. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.